Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have David Saxe with us. And David, I am very happy to be talking to you because we're going to talk multifamily today and what that world is all about. So if you wouldn't mind just giving us a little history of how you got to where you are, that would be great. And then we can follow up with the famous crystal ball ideas.
Okay, great. Thanks for having me. Excited to be on today. Appreciate it. I'm managing principal and co-founder at Calvera Partners. We're based in San Francisco. One of my business partners is also is located in Minneapolis. The three of us met while getting our MBAs at UC Berkeley, and subsequently worked for a $30 billion real estate investment firm based out of LA, where we did about $1 billion of deals across all product types. We did that through 2010 and then started Calvera after leaving that group. And we are value add multifamily investors. And all of our investors to date have been from our own networking, friends and family. And we continue to kind of grow from there onto the next phase.
So I'm curious, where did the name Calvera come from?
Sure. I get that question a lot. So there's a couple different meanings, and it's all tied to Cal Berkeley, since that's kind of what we all have in common as co-founders. Cal, clearly C-A-L, and then Vera, V-E-R-A, can mean true, so true Cal.
Uh-huh.
And then to give you another Cal connection, Calvera is a star in the constellation Ursa Minor, which means little bear, and Cal, go Bears. So you've got two. I usually go with the first one, though, because it's easier to explain.
Well,
True
they're
Cal.
both good explanations. I like them both. So,
Yeah. We didn't want to do the usual something street, something rock,
oh
like
yeah,
every other
yeah,
real
right.
estate firm. Not that there's
Yeah,
anything wrong with that.
didn't want to go with the Black Rock or any of those.
Yeah, we love those companies, but we thought we'd do something else.
Yeah, that's a great name. I love it. So you're invested in 12 different properties now in three different funds. So how is that all going?
Yeah, it's been a wild ride in multifamily over the last 5 years. When we left that large company, we started off really small. The three of us with our own money bought a 7 unit property in kind of I'd say an interesting area of San Jose, fixed it up, sold it, made a little bit of a profit. Then we moved to the next project and raised a whopping $1 million, I think, from 10 people to buy and renovate a 14 unit multifamily project in Santa Clara. And then we did a 42 unit project. Then we did an 85 unit project. And so before I get to the answer to your question, we've kind of gone from small value add renovations in Silicon Valley to acquiring and renovating to different levels projects, still in the Bay Area, but also now into Austin, Dallas, Fort Worth, and Chapel Hill, which is where a lot of California folks moved during the pandemic. So to set the stage, that's kind of where we own. How's it going? The last 5 years, probably, and anybody in multifamily would tell you this, to be an owner operator in multifamily has never been so challenging. The list of things that we've been facing on top of the pandemic, or since the pandemic, has been the following. Interest rates that have skyrocketed and been unpredictable. So if you weren't conservative with your financing, like we were, you might be losing your properties to your lender, unfortunately. You have inflation on the expense side. You have downward pressure on rents due to new supply. You have climate events happening, not just in the Bay Area, but in Texas and other places like that. Insurance has doubled. I could just keep going and going and going. Property management's been hard. So how are we doing? I think we're doing pretty well relative to a lot of our competition because we were conservative in how we underwrite deals and how we invest. So we like to protect our downside so that we you're not going to predict anything. I couldn't have predicted all that. I'll be the first to admit. But if you're not getting overly aggressive in how you're projecting rents when you buy it, and you don't get overly aggressive, particularly with the loan that you put on your building or doubling that up or whatever other people were doing, you're probably still owning right now, and you have some time to wait this out because real estate is cyclical. And that's what a lot of people are doing.
And you're still kind of looking to buy right now.
Yeah, well, that's such the interesting thing is that now is exactly when you want to be buying. When you see distress, when you see things that maybe you can buy at a really good price per unit. An example would be deals are hard to come by right now. Buyers and sellers can't agree on pricing. So when you do get a deal done, for example, mid last year, we bought 150 units in a great area of Dallas, Texas, 2016 construction, pretty low execution risk on the light value add. And you're just making a bet on that market, and on that neighborhood over, a long-term period of time. And, when you buy like that, you're upgrading your portfolio in every way. And we were able to buy this for 30% less per unit than someone bought before new in 2017 and 10% less than what someone's already bought since that time down the block. So in times like this, if you can find the money and find the deal, I think you make your money now. It's the price per unit that you're paying versus what you're going to ultimately sell it for as hopefully the cycle recovers here.
So you find a property, you look at it. So I'm curious, how do you determine whether the market's going to really work there? Do you do big market studies? What do you do?
Yeah, we spend a lot of time, and we come from heavy analytical and research backgrounds. For example, my first job was actually in the research department for equity office properties.
Oh, wow.
Sam Zell's company when they owned all the office buildings in the US. And we had to help the executive team figure out where to invest and why. Simply why invest in XYZ market. So, at that time, there weren't all these data sources available, and you kind of had to do your own data to figure this out.
Right.
Now it's a lot of scraping of data, looking at population figures, income figures, rents, supply, demand, and you spend a lot of time looking for markets that might make some sense. And so the markets that we typically focus on, none of these are going to be huge surprises, but it's improving demographics. So Dallas has been just growing just in a crazy way. You have a lot of folks moving there. You have an educated workforce. Incomes are rising. You have companies relocating there. That's a huge thing. Lower costs of doing business. There's a heavy, it could be heavy tech, heavy healthcare. Those are the markets that we're generally focused on. Dallas, for example, we like for kind of the reasons that I mentioned. A lot of folks from our neck of the woods moved there. Companies moved there. It's growing. Just the population has been growing so fast. Yes, there's a lot of supply, but it's probably going to get absorbed because there's a record amount of demand by the end of this year. And then rents might move back up.
So it sounds like you look for the market first and then you look for the property.
Yeah, for sure. We otherwise you'd go a little bit nuts looking at too many places at a time, and you wouldn't be able to do that. You've got to pick where you want to go, pick the metro, and then you may focus on a handful of submarkets if you can. And then what you start to do is you start to underwrite and value as many deals as you can in that market so that you can start to get an understanding of value, what you want to pay, why one thing is worth one price in one area and another price in another area. And that helps you hone your valuation model. Talk to brokers, you visit there, and then you start throwing in offers. And I think we've underwritten something like 500 plus deals in Texas.
Oh, wow.
And we bought 3.
I was that was a question I had.
You got to be discerning.
Percentage. Wow, 500 to 3. Okay, yeah.
In the Bay Area, that ratio might even be more extreme now that I think about it. Because Texas, we bought our first deal in Well, I take that back. We started underwriting deals in Texas probably in 2010. So.
Oh, early. Yeah. So
you got to understand what you're doing, especially if you're going out of state. Your investors are going to always ask you, how do you go buy? I get this all the time. How are you going to go buy something in Texas when you're sitting there in San Francisco. I don't get it.
Yeah. Well, I mean, I understand that, but I guess investors don't quite get that.
There's an old school, I think, and I get it, model where before a time where it was very easy to get to these places, the data was readily available, Street View on Google Maps,
Yeah.
Zoom. I mean, there's just a lot of tools where you can really learn a lot by sitting right here to start. And then you still go out there all the time and you visit and you talk to people and you learn markets. And it's what the three of us did for a very large company from Los Angeles. Uh, and now we're just doing it from here. And we did get our start actually buying local. And
So,
yeah.
so what would you say? This may be and you maybe can't answer this, but what would you say when you're looking at 500 properties and
Mhm.
you only buy three, when you eliminate that many other properties, what do you say? What do you think the biggest glitch is when you look at those properties? Just the income? What?
Yeah, so what we're usually trying to do in these deals, unfortunately, multifamily you can underwrite fairly quickly versus, office can be a little bit more complicated or something, or a development. You're trying to get to certain metrics with a very quick initial first cut. So let's just
Yeah.
say, for example, you're trying to stabilize at a 6% return on cost
Okay.
after a couple of years.
Okay.
When you quickly throw in the expenses, clean them up a little bit, throw the rent roll in there, throw it into your template, you're going to know pretty quickly if you're within range. And if you're not, you're probably moving on. You can move pretty quickly on to the next one. You're also sometimes looking for a unique story in today's world. Is it distressed? Or is somebody in trouble? Investors always like that. I think people try and find sometimes a story, lead with the story because they can sell it. Whereas we just bought this deal in Dallas at a very good price per unit, and people say, "Well, what's the catch? How did you do it? Was it distressed?" Sure, I'm sure someone wanted to get out, but no, it was just a good time to buy, and that's why we did it.
Yeah. It was the right time, the right
Yeah.
place, and you had the funds and off you went. So
Yeah, yeah, just because I can't tell you some horror story about it. I get that though, that's what sells and clicks and things.
yeah, everybody's looking for well, particularly investors are probably looking for, well, why did we get this special deal? Yeah, and then they
There
want
was
to know.
there's a catch.
Yeah, yeah, yeah. So, I mean, used to be expenses ran like 35%. So is that number still good these days?
Yeah, no, absolutely. So yes, it clearly it ranges though, because we'll look at deals and it varies depending on where you're in the cycle. Sometimes these deals from say the 70s and 80s in Texas or in
Yeah,
the Bay Area, we started buying 1960s buildings. You might have a higher expense load there
yeah,
for sure. It could
right,
creep a lot higher. So you need to be more conservative when you're valuing these deals in your model to project higher expenses, deferred maintenance, and man, things just come up in old buildings that you can't predict. So
right.
your numbers are still right, but we've seen a pretty big variance depending on how new the products are.
What's been your biggest surprise in some of these older buildings that
Oh man, when we got our start, we bought deals in Silicon Valley from the 60s and we bought them at a good time. We started our company in 2010 and man, I wish I'd bought every possible thing
oh
I could have gotten my hands on. I mean,
yeah.
we bought a 1960s, 42 unit building in Sunnyvale for 144,000 a unit in
Wow.
2011. Today, even with things not going very well in the multifamily market, you're still going to be paying north of $300,000 per unit for that same
Wow.
thing.
Yeah.
So we didn't realize when the sky's falling, you don't realize you're scared. But to answer your question, what are the craziest things that we've seen in that building? You know when you're buying a 1960s building and you're asking all the questions and sending your people in there, that there's going to be old pipes,
Oh yeah.
right? Generally, you're going to find subfloors that have issues, water intrusions, things. This was interesting though, because when we started our company, we wanted to kind of learn property management. I mean, we managed other managers at bigger companies. And so we self-managed, for example, that 42 unit building.
Wow.
Bought it really well. There was a husband and wife team, so we had plenty of cash. We were conservative on the buy. But I think we got a call one day many years ago, and they said the hot water stopped working.
The company just stopped.
What do you mean? And you ultimately found out, and no matter how much due diligence you could have done, you never would have known this. We had to repipe the whole building.
Ah.
And the building had 40, it was fully occupied.
Oh,
And
geez.
we're self-managing. So, we bought the building right. We had reserves. But that is a $250,000 exercise, on at the time was a $6 million,
Yeah.
acquisition. There's
Right.
people living in it. Which is nuts. There's asbestos that you have to abate. Now,
Oh, God.
ultimately, we got through it, and that ended up being, I think, our best performing deal to date because we bought it for 144,000 a unit. Got through that. This was the worst
Fix.
list ever
Yeah,
happened.
the
That's the
fix.
thing I told you. Uh, and
Yeah.
then sold it at a big number. So that's an extreme example. When you're
Yeah.
buying in 150 to 300 unit buildings in Texas or North Carolina, you're having deferred maintenance, but nothing like that has ever come up. I think the biggest thing people face right now is weather events that are unpredictable.
Oh.
In Texas, which you wouldn't have anticipated. In Austin, we owned 300 units in Austin, and there was that winter storm that hit a few years ago.
Oh. Oh, yeah.
And
Everything froze up, right?
yeah, and
Oh my
I
God.
mean, it's Texas. What's going on?
Yeah, that's not possible.
Right, and it's possible now. And
Uh,
so you have insurance and things like that, and we did fine, but you just have to be conservative and think about all your risks. You're never going to predict it all, but you need to have cushion for things to happen that you don't expect.
what do you think a reasonable cushion is these days?
Um, well, so for example, and we have funds so I more think about it that way, where let's just say
Uh,
there's a $30 million fund, you're going to want to have a couple $1 million,
yeah.
for a rainy day. Originally, when you were buying a $6 million building, yeah, you don't obviously need that much. $500,000, something. I mean,
Yeah.
it's kind of gut feel. And
Right.
as you fix things up and do your value add program, you probably feel more comfortable with lower level of reserves after a while. But this is why people sometimes when they buy what's called value add multifamily, they're getting out because they don't want to wait for the next issue to happen. They're getting
Oh,
into their business
interesting.
plan, get out.
So are you trying to mitigate some of your insurance costs by reducing some of the insurance risks?
Insurance has been, man, if the amount of minutes we talk about insurance on a daily basis, well, this is everybody now too.
Oh, yeah.
And this is why multifamily owners have been hit pretty hard, and that most of the insurance rates have doubled.
Yeah.
So take one of your line items. If you bought a building, and you couldn't have predicted this, uh, when you take an insurance line item and double it, that's going to hit your net operating income pretty hard.
Oh, yeah.
And there isn't a lot that's why you need to be conservative in how much cash you have and operate well. There isn't a ton you can do. So if you're in a 1960s building, some of the things that you might want to do is you're going to upgrade your electrical system. And
Oh,
we
right.
talk a lot about that. There's a
Yeah.
big thing happening right now. That was a friend of mine actually has a company that called Knob and Tube that
Oh,
that is dealing with one of these issues right now. His entire business plan, and he was just on ABC News, I think this week about this locally here in the Bay Area, is fixing up this old dated knob and tube electrical system. Um, Sometimes though, you're not going to get compensated for that by your insurance company. Like they're not going to reduce your
oh,
costs. That's really only going to benefit you when you sell the building because the next guy knows they don't have to spend the money on.
right, right. Yeah.
So it's not necessarily even going to help your in place. Actually, it's probably going to
That's
hurt your in
interesting.
place
Here you
cash
spend
flow.
all this money and you're not going to get any real benefit out of it right
Yeah.
away. Yeah.
Um, you're obviously looking at seismic retrofits, but that's always been the case when you're buying a building. That's
Right, right.
nothing new. The big one right now is fire potential in some areas, not everywhere, but it's just really a slog to be operating apartments right now. And don't even get me started with some of my competitors that had floating rate debt. Uh,
Oh, yeah. No, you
so
can get killed. So so have you actually ever had to go through and sprinkle a building?
we have not had to add anything. Well, I take that back. When we bought a 1960s building in Sunnyvale and renovated it, it's a longer story, but we converted the old open air mail room into a common area, and I think we probably had to do something there
Yeah.
to
Oh,
get
okay.
up to code. But
Yeah.
generally, that's been less of an issue. And because we don't own anything in Marin County
Yeah.
or Santa Rosa or anything like that.
High
Uh,
fire.
yeah, we're not, it hasn't been as much of that has not been as much of an issue for what we've been doing. It's just random cold and climate events and doing things to try and mitigate that as much as you can.
Well, and in Texas where you didn't think it was ever going to freeze.
Correct. Correct. People were caught off guard. We've been fortunate in that, yeah, there've been owners in those areas where inside of the units have been impacted, pipes go out, washer dryers might be on the balcony, and
Ooh,
those have issues. I mean, I think when this happened in Austin a few years ago, if I remember, they didn't even have snow plows,
oh no, no, they never heard of
right?
it.
Like there was
Yeah,
nothing that it was a
right.
mess.
Oh yeah,
And then
no.
their whole company out there, the equivalent of PG&E, is done differently, and there was all sorts of problems.
So did you go back and do any kind of retrofit for cold weather? Probably.
Wait, so for in our particular case, yeah, this was great. We bought our largest deal ever as a company, 300 units in Austin, Texas, and I covered Austin at the previous large firm that we left to start our company. And we bought that in February of 2020. So 2 months before the pandemic hit,
Oh,
which was
God.
scary.
Yeah,
Out of
right.
state, largest deal. But as we know, Austin just really grew fast. A lot of people from
Oh yeah, it
California.
was right through the pandemic.
We got hit with that winter storm partway through our hold period. We needed to go through a whole insurance process we did it and to fix things up. And then we saw Austin getting frothy from a valuation standpoint. I mean, people were buying things at three caps there. I mean, it made no
Oh
sense.
wow.
And we sold our deal in one of the last days of 2022
Oh wow.
and got out. And that week, there happened to be another winter storm that we thought was going to kill the deal because of a little bit
Oh,
of things that happened. And because
God.
of something that we were smart to negotiate in our contract, it went through. So we didn't have to deal with it there. And then we've been fortunate in Dallas. We haven't been hit very hard. It hasn't really hit our property in North Carolina. So, we don't buy in Florida though. I mean, that's a
Hurricane country, not going for her.
yeah, but to go back to where you started, people did not think originally when you bought in Austin, Texas, you'd be dealing with this stuff.
No, not at all. I
Yeah,
mean, no way would you think that, let's insulate our pipes because it
right.
might freeze. Like,
Exactly. You're
what?
thinking the
No, are you
opposite.
are you crazy? No.
Right.
Oh my God. Wow. So insurance did cover some of that cost. That's
It
it.
did. No, insurance was fine. We had to navigate that process. It was complicated. We did get through it. We did get a check. It takes a while. And while you're navigating that process, you're still kind of having to fix things up and you need cash and
Right.
that's what back to where we started, having those reserves.
Yeah, you
Because
gotta have reserves.
there's a timing difference potentially on when we had to do some fixes and got the insurance check.
No, that's a very well, and I think some of the smaller groups or even the larger groups that didn't have good reserves ended up just having to bail out. And for companies like yours, that's an opportunity.
It
But
is. It is. It absolutely it is. And so yeah, going back to the original part of the conversation too, let's just say you had floating rate debt you bought at the wrong time, you got hit with a climate event, your insurance rates doubled, your expenses went up because of inflation, a ton of supply moved your rents down. It's hard to overcome all of that. So you're gonna there are buying opportunities, but only if someone is being forced to sell. If you have fixed rate debt, everyone right now is kind of hanging on for as long as possible because it makes no sense to sell into the market right now where the valuations aren't great. So you're just gonna, that's why many deals are getting done. It's
Yeah.
just,
No, if you've got a lower interest rate, you're just going to hang on by your teeth as long as you can. Yeah. So just out of curiosity, what's your crystal ball saying about the San Francisco Bay Area these days?
yeah, absolutely. So my office is in downtown San Francisco. I'm from the Bay Area, live in the Bay originally and live in the Bay Area. We still own in Silicon Valley and in the East Bay. So very familiar with those markets. Um, wh- we spend a lot of time actually, and it depends on what part of the Bay Area. We're actually very excited about the changes we're seeing in San Francisco
Oh,
and what the new mayor has been able to do there. Uh, there's a lot of positive change already happening. Coincidentally, I have a place in Mission Bay, which has been I wish I could have told you I predicted that. I mean, I guess I somewhat did, but OpenAI opened an office space there. Mission Rock Park is happening, the Chase Center. Things are going really, really, really well in that neighborhood. So we're actually pretty excited about the recovery of San Francisco. Clearly there's a lot of structural problems, but things are looking up there, and everything I'm hearing from my colleagues in the industry is people are getting excited again about investing in apartment buildings. To some extent, office is starting to, people are going to get excited there, buying now. So San Francisco, I think, is looking on the ups. We do
wow.
own a small building in Oakland. Cannot
Yeah.
say the same thing about Oakland.
Uh,
So Oakland has been, I don't know how else to say it. I mean, it's just been a disaster in terms of what's been going on there. It's unfortunate. A lot of groups invested into Oakland, pre-pandemic. All the big players built these big, beautiful buildings, which is great for Oakland. I think Uber at one point was going to move their headquarters
oh,
there.
yeah. Right.
Yeah.
Right.
A
Kaiser was
lot of
going to
excitement.
build their headquarters. It was
A
going
lot
to,
of excitement.
yeah. Yeah.
And because of the pandemic and then systematic and political problems and people not running the government right, many of those big, beautiful new residential buildings are now owned by the lender. Um, the mayor, I recalled, it's going to take a while to work through that mess. So we've probably hit bottom in Oakland, but it's going to be a long journey there, is my prediction there.
Oh,
There was also just a ton of supply already, which doesn't help that market. And then Silicon Valley is pretty interesting. Like we're seeing a lot of it is correlated with bringing people back to the office.
right.
I guess that's true of San Francisco as well. And the mayor's trying to bring his people back, and companies are starting to do that. We were definitely impacted in our Silicon Valley buildings when all the pandemic won, and then tech companies kind of continued to let people work from home. It's not gonna help. Um,
Right.
it is, we're starting to see some upward pressure on rents in the Bay Area. I'm sorry, in Silicon Valley.
Hmm.
I think it just kind of depends on the specific city. For example, we own in Mountain View, and you would think that that would have recovered first because it's Mountain
Interesting.
View.
Right. Yeah.
It hasn't.
Oh,
Could be correlated to Google still having a bunch of people at home and them having such an impact on that city. It's tough to exactly say, but look, the Bay Area has always been boom and bust since I came from the grew up here, been in the office market at Equity Office in my previous life. It's boom and bust. There is so many things to like about the Bay Area. The Bay Area just needs to sometimes get out of its own way. And what we have experienced over time is that it's become increasingly hard to be a landlord in the Bay Area. In addition to all the problems that you're seeing in multifamily that we talked about, if you're then battling eviction moratoriums and the government trying to get involved in every aspect of even a value add project and rent control, and can you make a lot of money in that environment? Yes, but even my own investors, many of whom are in the Bay Area, even got tired of it, particularly with the Oakland eviction moratorium.
Oh yeah.
That go buy in Texas.
No. Oh yeah. No, well actually I was going to ask you about that about what about rent control? How
Yeah.
was that affecting things? And it's still a big deal.
So yeah, real quickly on rent control. I have many friends who are, I'm in my mid 40s, who still live in their rent controlled apartments. I can tell you they don't
Wow.
need them. So
Yeah.
because it's not needs based, I don't know if there's a better way to do it, like logistically, but I can tell you they don't need rent controlled apartments. So that's a problem number one.
Right, right. But
Two,
there
what I hear is it's the politically expedient way to go. So I think if you gave politicians a lie detector test, all the studies show that it makes absolutely no sense and actually doesn't help affordability, but it gets votes. So I think there's that. We all know that the way to solve this is to build more supply. And yes, I get it that the numbers only work sometimes when you build luxury housing, which again isn't good politically. However, eventually, similar to the 60s buildings we're buying, it's going to be new supply, and I'm an
right.
economics major, downward pressure on rents.
Yeah.
So it's it makes it is what it is. You operate within the system, and as someone that invests in multifamily and has bought rent controlled apartments, you have to underwrite as carefully as possible, but be wary that you may not get the rollover of the rent
Right.
controlled apartments as fast as you thought. And if you're an upstanding landlord like we are, you kind of just have to wait it out.
Yeah, you just kind of go with it. Well, is there any remote chance that rent control in San Francisco is going to get reduced or eliminated?
No way. If anything, I think I just saw last week that the state of Washington is about to pass rent control.
Oh, wow.
I mean, it's if anything, it's spreading.
Uh,
Uh, um, no, what I think you'll see happen more, and I've been seeing this with the new administration. I think people realize that lack of supply is an issue. I'm seeing moves by city governments to try and at least make it easier to build and not get stuck in all this red tape.
right,
Take
right.
10 years to get something out of the ground. That I think would happen, but I don't see things like rent control going away or Prop 13 going away, or I just don't politically see how that would ever.
Well, right now the driver, well, maybe at least from my vantage point, the driver is interest rates that nobody can get a construction loan or very few. So,
Interest rates are the biggest thing, whether you're a developer or you buy existing products like us, that is kind of stagnating, causing the market to be kind of stuck. Because if you don't know where your interest rate is going to be or it's elevated, how do you decide what your costs are going to be, what your purchase price should be? And we've been in this area where everyone thought tail end of last year that our interest rates are going to go back
yeah,
down.
right, right.
Everyone got
Yeah.
excited, and then the opposite kind of happened. And that's why deals have fallen out of contract.
Wow.
For my business, if interest rates are elevated and costs are elevated due to tariffs, that means there's not going to be development, which means that there's going to be upward pressure on rents on existing buildings.
Oh my God. Oh, well, that's interesting. All right. So, yeah, interest rates don't. So that's wow. I never related tariffs to interest rate, but you think there's a
Or
core?
I meant more like I meant more if you combine elevated interest rates,
Yeah.
elevated construction costs because of tariffs,
Oh, yeah. Okay. All
all of
right.
those things
Yeah.
combined make it
Right.
harder and harder to justify a development project of market rate housing. If there's less supply, then rents are going to go up in existing buildings, and this is why we have a problem.
Yeah. So it just,
Societal problem.
yeah, yeah. It's not going to happen. So all those empty vacant lots are probably going to sit there for a while longer.
Yeah, yeah. I don't see how the numbers can make sense and the people can take on that risk, short of the government somehow deciding to step in and say they're going to help out, or provide some incentive. But the new administration doesn't seem to be nationally, seems to be doing the opposite. So uh, it's probably going to eventually cause upward pressure on rents in existing multifamily projects because of the lack of new supply demand.
Well, so kind of last question here,
Yeah.
maybe. Uh, where are you finding money these days, other than investors? Conventional loans? You going to institutions? Where are you finding money these days?
Yeah, well, for on the financing side, we work with Freddie Mac, Fannie Mae is usually still the best game in town to get new financing. And because you know what your interest rate about, I mean, you don't know exactly, but my general point is when you buy a new project, at least you know your interest rate is now here. It's not like you're trying to refinance, so you can somewhat try and ballpark what you should pay for a building. On the fundraising side, for us, it's a lot of word of mouth. So we work with about 200 different friends and family, and that's grown organically over time. We're doing outreach in the form of marketing. All three of us went to Haas Business School, so we're always trying to work that network because communities like to support the same community there. But everybody, is struggling right now. I don't care unless you're a big brand name like Blackstone. It's really hard to raise money in this environment, which it is what it is. It's frustrating though, because now is when you want to be putting the money out. And so we're constantly in touch with our existing investors, reaching out to new ones, and trying to get them comfortable. And it's a lot of education. Why multifamily? Why it makes sense? What are the tax benefits? How can we help you mitigate risks? Uh, you have to talk to people and explain to them your business and why it makes sense for them. And I'll be honest, there's been a re-education process because so much money was made in multifamily when interest rates went to zero and rents went to the moon. But the
Yeah.
returns that we were able to generate were amazing. And I still think we're good at what we do. But the ability to continue to generate a 20 or 30% IRR on an existing multifamily project, people got used to that and think that's normal. Well, the normal is probably 10 to 12 or whatever it is. It's
Yeah.
hard psychologically to tell someone that. And and they eventually get it, but you have to really educate them on how this is supposed to work. Multifamily is not as risky of an investment as a retail project or a hotel or a development. It's
Or the stock market in general.
right. It's a cash flowing asset. So that's a lot of my job. And I have a business development guy we hired to help me with that, and we do a lot of marketing and educating, a lot of educational pieces.
So do you see down the road somewhere that you might, if you keep growing, you might do a public offering?
Well, so our newest investment fund called the Calvera Income and Growth Fund uh, is structured, without getting too technical, is structured as a fund above a private real estate investment trust. One of the reasons why we did that, in addition to the tax benefits and other things I could get into at another time, is the ability down the road to take something like that public and
Mhm.
give people shares, which would be still not a taxable event. So that particular fund, we could. Our existing other funds, they're just private, typical closed-end funds where you buy, you have a specific hold period, and then you exit at the end of the fund's life. So the new fund we was based off of feedback we got from investors that would tell us you have a nice asset, say in a good market, don't sell just because your fund life is over. Keep
Mm.
it. Let's continue to collect the checks and utilize whatever tax benefits we can from real estate and hold. And let's do it that way. And also they didn't hold just real estate is supposed to be a long-term asset. It's not the traditional model is not go in and flip it in a year. That
Right, right.
and people got used to that, and that's never how we've looked at real estate investing, or my late grandfather looked at investing. You buy real estate, you hold, you take the cash flow, you refinance. That's how we look at it.
So tell me a little bit about your grandfather. He was
Yeah. So he moved to Palo Alto with his family in 1959 from the Midwest. and he, smart business guy, didn't know real estate development, put an ad in the paper to find a guy who knew development. And they were just two smart, driven guys that believed in Silicon Valley back then, and they ended up building about 1,500 apartment units, all in the 60s and
Yeah.
70s. Everything I'm doing is completely from scratch. Like, I've had to do all my own fundraising, everything else. He unfortunately passed away right when I started my company, and everything had been sold prior to that.
Oh, wow.
That being said, he was a good inspiration. Um, but yeah, I found the old files where I found a rent study from Sunnyvale from 1967 or 8 where rents were
Oh,
$150.
wow.
I found the financial analysis that was a 1-column financial analysis done on a typewriter, capped at a 10 cap. There's no Excel. There was less red tape, but you read these things and the guts you had to have and the vision of what Silicon Valley was going to become took a lot. And all those buildings are still there. They've just been bought by other people that have done value add
Right.
projects. So he was a good inspiration. Unfortunately, he did pass right when we started. Though he could have probably been really, really helpful to me. And we've worked really hard from $25,000 checks from business school classmates when we started to, larger checks now.
Yeah, that's fantastic.
Yeah.
Well, this was a very fun conversation. We'll have to continue this conversation down the road here every quarter or
Loved it.
year or whatever, update as we go here. But where would people get a hold of you?
Sure. Yeah. No, thanks. So you can feel free to add me on LinkedIn, David Saxe, Calvera Partners. We post a lot of educational content about multifamily. Follow our company page on various social media accounts. And then if you go onto our website, calverapartners.com, you can sign up at the bottom of the page for what we call our biweekly insider, which is we've gotten good feedback on it. We have thousands of people on it. And it's our take on the multifamily market every 2 weeks. My business partner writes original content every month, but we do put stuff out every other week. And yeah, I'm always love to chat with people about multifamily, about what we're up to. So don't hesitate to reach out.
Very good. Well, I'm going to go sign up. I don't know about all you other listeners, but I think this has been a very beneficial conversation for all concerned.
Appreciate you having me on.
Thank you. We'll talk to you soon.
All right, sounds good.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.